7 secrets to getting rich. Here's the problem. It's not a secret.
Finance doesn't always cross paths with philosophy, but sometimes there's bound to be an intersection. Believe it or not, everything on Earth, no matter how large or small, is bound to one law, which is the law of cause and effect. A powerful universal law that states that every single action in the universe produces a reaction no matter what. It notes that everything we do or see today was caused by something else and was merely a consequence of another. This principle is fundamental in many disciplines, like philosophy, and is mirrored in Newton's third law of motion. Nevertheless, this universal principle is also true in finance, because every financial decision you make today must come with a consequence, be it good or bad. For example, prudent investing and sound financial management may result in wealth accumulation, while irresponsible spending or risky investments may lead to financial setbacks. Understanding cause and effect relationships is fundamental to making informed financial decisions and achieving long-term financial well-being. And that's why everything that has to do with money is an invitation to critical thinking.
And you've got to study and think about this money stuff through the lens of behavior modification. It's not a math problem. So how do I modify my behavior?
So, if you're to take control of your cash and want to get ahead on your journey to financial independence, then keep watching, because this is the most powerful approach to how you can win with your money in 2024 and beyond. But what's a train without a railway? Without a path, giving you a guide wouldn't make sense. On that note, the first thing we will be doing today is correcting one of the biggest mistakes people make when it comes to money management, which is not applying the first principles thinking model. For the uninitiated, first principle thinking involves breaking down ideas to their fundamental truths and building it up from there. It's about questioning assumptions, thinking creatively, and solving problems in innovative ways. Funny enough, while first principle thinking is an important ingredient for success, especially when it comes to money and business, it actually strikes a stark contrast from our default way of thinking. As humans, we all love our analogies. We like to lean on our prior knowledge and back it up with a comparison between two similar things to make assumptions based on what they have in common before coming up with ideas. For instance, Anna is an experienced investor who has successfully employed diversification strategies in her portfolio. She understands that spreading investments across different assets can help manage risk. Shortly after, Anna comes across a new financial product, let's say a unique type of exchange-traded fund, or ETF. By applying analogical reasoning, Anna reflects on her prior experience with diversification. She draws an analogy between the new ETF and the concept of diversification she's already familiar with. By doing so, she presumes that similar to diversification, this novel ETF might aim to reduce risk by investing in a variety of assets. Now, as you can probably imagine, reasoning by analogy is not inherently bad or wrong. On the positive side, it serves as a valuable cognitive tool for learning from past experiences and applying that knowledge to new situations. This allows us to make quicker decisions based on familiar patterns, particularly in a field like finance, where prompt decision-making is often crucial. But alas, there are potential concerns associated with analogical reasoning in finance. One notable risk is the tendency to make assumptions about similarities between situations without adequately considering potential differences. If the analogy is oversimplified or fails to account for nuanced distinctions, it could lead to flawed decision-making. And to make things worse, analogical reasoning is prone to promoting biases or preconceived notions, which could also influence decision-making. Think of your financial life as a tree, with the root being your values, as that's what matters most. Out of these roots stem the trunk. Let's call that your mental description of the type of life you want to live financially. Of course, every good tree needs a branch, and this area represents the steps you're putting into place to actualize your financial dreams. After you have those strategies in place, you're going to get leaves, which are the products that reflect the consequences of not just your strategies, but also every decision you make on the way. Guys, make no mistake, Dave Ramsey is absolutely right. All of our money habits, behaviors, and patterns come from our beliefs and attitudes about money. And that's why the first thing you need to consider on your journey to improve your financial life is to examine your money mindset. On that note, you're probably wondering why first principles thinking is so important for investors, aren't you? While we admit that money management and investing are too nuanced to have one solution for everything, the truth is that this method is the most powerful. For starters, first principles thinking helps investors deeply understand the fundamental factors and dynamics of an investment opportunity. Breaking down complex issues into essential components provides insights beyond superficial analysis, aiding in recognizing value drivers, competitive advantages, and potential risks. Secondly, first principles thinking assists investors in avoiding the influence of emotions and biases. And don't even get us started about the fact that it promotes a long-term perspective for investors, encouraging a focus on enduring principles rather than being swayed by short-term market fluctuations or shaky day trade opportunities, promoting discipline and introspection. With all of that out of the way, let's get on to the next section, which is about financial independence, the simplest ways to get it, and the ultimate stumbling block. But before we begin, you might want to pay close attention because this second part is just as important as getting the right mentality. Have you guys ever wondered about what financial independence means to you? And no, we're not talking about the cliche definition of working for a long time to accumulate enough financial resources and assets to sustain your desired lifestyle without being dependent on employment. Believe it or not, there's more to financial independence. It signifies a level of financial freedom where one's passive income, generated from investments or other sources, covers all expenses and discretionary spending with more than enough to spare. It's as simple as you spending $400 a month and making $4,000. And of course, it's easy to see why that's the ultimate goal for every investor. Achieving financial independence means you have broken free from the necessity of traditional employment, providing the freedom to make life's choices based on personal preferences rather than financial constraints. It allows you to pursue passions, take risks, and shape your life according to your values without the constraints of financial obligations. That said, contrary to the common misconception, financial independence doesn't necessarily coincide with old age or retirement at age 65. While the traditional narrative suggests working until retirement age, accumulating savings, and then enjoying financial freedom, this cliché perspective has long evolved. Many people have gained financial independence at a much younger age, and there's absolutely no reason why you can't too. As simple as it seems, all you need are three things: aligning your spending habits with long-term goals, harnessing the power of compounding, and making well-informed investment choices. But here's where things get interesting. Depending on where you are in your journey to gain financial independence, you need to take three crucial steps to bring your goals into reality: grow the gap, invest the gap, and repeat. To grow the gap means expanding the difference between your income and expenses. Achieving this involves either increasing your earnings, reducing your spending, or a combination of both. For low-income earners who make around $20,000 to $30,000 a year, your goal is to increase your income by making Benjamins from as many income streams as possible. If you're earning a substantial income but struggle with overspending, the initial step is to tackle your spending habits and address the underlying psychological factors contributing to them. And what's a better way to do this other than creating a budget that works with your lifestyle? It's one of the things that Dave Ramsey always preaches. Now, there's this practice that people make regarding budgeting. They only make
Can you sit down and do your dadgum budget, maybe for the first time in your life, put your income for the month at the top of the page, and then give every dollar an assignment? I will promise you two things will happen. Number one thing will happen is that you will feel like you got a raise because you will go, where is all this freaking money going? And the second thing that's going to happen is you're going to get a sense of peace instead of a sense of anxiety, even though you've actually done nothing with money yet.
Now, there's this practice that people make regarding budgeting. They only make them when their earnings are deemed worthy enough to budget. But we believe that this is wrong. The best time to budget is now. And to address this, here's an amazing explanation from Dave Ramsey.
You don't have to wait until everything stabilizes to start doing a budget. As a matter of fact, the only way it will stabilize is to do a budget this month, and then do a budget next month, and then do a budget next month.
That said, once you've curbed unnecessary expenses, The next step is to save and invest a minimum of 20% of your income. When I save and invest, that includes making debt repayments beyond minimum payments, creating emergency funds, having retirement savings, investing in an investment account, or even having a go at the stock market. Begin by aiming to save 20%, and if you're far from that target, gradually increase your savings rate by 1% every month or two. While it may take some years, this approach will eventually lead you to the 20% savings goal. However, you've got to plan for inflation. The Federal Reserve has implemented substantial rate hikes to counter inflation and stabilize the balance between supply and demand. Despite these efforts, the impact on basic necessities is substantial, with prices already experiencing significant increases. When constructing a budget, it is crucial to acknowledge the reality that the costs of most expenses are likely to continue rising. Step 3, however, is to repeat. In case you need reminding, managing money isn't a one-time thing. It's a lifelong practice, not a quick fix or an overnight achievement. It's a continuous process that you need to do for as long as you live. That said, don't fall into the trap of being narrow-minded or not considering unknown factors that could aid or derail your financial journey. Throughout history, the world has consistently experienced volatility. A century ago, during a pandemic, the world also faced the challenges of the First World War. A decade later, the Great Depression unfolded, followed by World War II. To this very day, a series of events have continued to impact the world economy, like COVID-19, which slowed down the economy on one hand and made a lot of millennials rich through cryptos on the other. Nevertheless, what if we told you that, despite everything we've discussed in today's video, one thing can forever derail you on your journey to financial freedom? Yep, you heard that right. Even if you follow all the methods down to the last letter, you're still going to live from paycheck to paycheck. Do you have any idea what this stumbling block could be? Ponder not, because the mystery supervillain is your debt. Believe it or not, getting out of debt in order to invest is the quickest and best way to build wealth for a lot of reasons. To start with, your income is the most important wealth-building tool that you have in your arsenal. As long as your money is tied up to monthly debt payments, or any kind for that matter, you're not going to be able to gain financial independence. It's like trying to run a marathon with your legs tied together. It simply won't work. Secondly, how are you going to make your all-important emergency fund if you still have debt to pay? You will end up taking lots of money from what should be your leverage against emergency expenses, and that could jeopardize your financial future in the process. When it comes to paying off your debts, you've got to be ruthless. Delay is not a smart decision. You'll inevitably still have to pay it back. And secondly, the compound interest will be a pain in the rear. But don't fret, because eliminating debts is simpler than you think. One of Ramsey's tried and true ways to eliminate debt is the Snowball method. And boy, does it work wonders. Check this out.
We started calling the debt Snowball. And it's a real tough metaphor to grasp. You list your debts, smallest to largest. You pay minimum payments on everything but the little one. You attack the little one with a vengeance.
In a nutshell, this method connotes paying off your smallest amounts, then your largest, which creates bigger momentum, like a snowball rolling down a hill. Celebrating small victories along the way helps maintain motivation, preventing feelings of being overwhelmed before addressing the largest burdens. While you focus on paying your smallest debt, ensure that you still make minimum payments on all other debts. Then, once you finish one line on the list, mark it off and move on to the next. You'll be debt-free in no time.